Hello everybody, my name is Dave Osmond and I am going to introduce the presentation today. We're really excited to have Andy Abraham here with us to be a part of our education series at MetaStock. If you have a Kindle and you've been to the Kindle store looking for anything having to do with trading, you've sure seen his name around. He's a well-known author and has some really fantastic training books out there. Now I'm going to turn over the time to Mr. Abraham to go ahead and give what I think is going to be just a fantastic educational experience for everybody. Go ahead and take it away, Andy.
Well, first of all, thank you very much, Dave, and I want to thank Derek also from MetaStock for giving me this opportunity. And I've been a loyal MetaStock user since 1995. A lot of years. I'm hoping to give everyone almost an aha experience in tonight's discussion. And tonight's discussion is going to be a little bit different than probably many other webinars that you've gone to. Before we start, this is a book that pretty much is going to discusses the ideas, and it's applicable. I have a stock trading version, a commodity trading, a forex, and a day trading. And really the idea of what I'm trying to espouse to you is to think in different ways that really have not been presented to you. I have a disclosure also, because I'm also licensed. I'm a money manager. I'm a commodity trading advisor. And so this is my disclosure for regulatory purposes. Let me jump to the next slide. Besides being a money manager, I've written several books. Dave alluded to that. Basically, the first book I have is called The Bible of Trend Following. I've been a trend follower since 1994. This is what I do. I also wrote a book because my goal is to compound money. Your goal needs to be compounding money. And also, I realized that, as my wife will say, I'm not perfect. But I allocate to other money managers with the goal of compounding money. And this is what this is all about. And this is what I've been doing since 1994. There's much more to trading, or let me even qualify that, successful trading, than having just a strategy. And now that we have this chat box here that I can see, I'm going to ask you guys some questions. Because the questions I'm going to ask you are almost like, it was like a wake-up call to me myself. How many trading books do you have on your shelf? If you guys can just, type in there in that little box. Okay, we have one person says 5, 3, 100. Dennis has 100. Okay. 4. Okay. 150. Wow. 50. Let me go to the point. How many courses have you purchased? And these courses are not cheap usually. 6, 5, and seminars, I'm assuming it's also a vast number. So then the question comes, which the question I asked myself is, I bought all these books also. I'm looking at the shelf right across from my desk right now, and I'm probably hanging out with Ross. I don't want to say 150, but maybe I'm close to Dennis with, I have 100 books. And it didn't, none of these books really made me successful, and they were all trading strategies. The other reality is, unfortunately, most traders fail. And what I do is, I trade daily charts. I trade stocks and I trade commodities. I manage money for commodities. I have a lot of time because I put, you could say, almost 19 years of time for my hours worth of trading maximum. Maybe that's all it takes me a day. And the biggest issue really comes down to is this psychological battle, or this mental battle. So one of the things that really helps me is I teach. I talk to people all throughout the day. And really the thing that it's going to relate to our discussion is all the time people, or traders specifically, are looking to avoid losses. They're looking to avoid whipsaws. They're looking to find that perfect, if it exists, time frame. Or they ask me, what length moving average do you use? What length or what parameter to use in this indicator or that indicator. Well, guess what? It doesn't matter. You have to accept the fact that we are going to have losses, but our goal is to keep them small. Strategies do not make a good trader, but I'll qualify that. You need a robust strategy that matches your personality that you can follow. And I got really lucky. I had a mentor. I had two mentors. One of them actually learned under Ed Seykota and under Van Tharp. And another, ironically, I sold a business that I started in college, and I asked my accountant, because he has a pretty large firm, and my attorney, who their most successful client investor is. I was given a name and a phone number, and it was a gentleman that started in 1979, and he was doing hand charts, and he basically was my mentor. That, you have all these courses out there, and the reality is you never really taught how to trade. You go to college or in school, or many of these courses really don't teach you, unfortunately. This is the big deal here. There is no holy grail. There is no magic system. There is no magic indicator. And you know what the big thing, what I really want to give you this aha experience, you have to accept the reality when you put on a trade that it might not work. That you accept the fact that it's okay to have a loss and not try to prevent them. And this is not just also with your own trading, but also when you allocate, or if you allocate, you invest with other money managers. I mean, there is, and we're going to get into that a little further on some of these slides. I'm sure, and I want to see a raise of hands again. How many of you, after a series of losses, 4 in a row, 5 in a row, 10 in a row, you'll say these things: the system is broken, or this guru that you're on some service that he doesn't know what he's talking about, and then you're going to go find another system. Let's see a raise of hands. How many people feel this way or have felt this way? Okay. Everyone's saying the same thing. And this is almost going to go to the point where I want to make and give you this aha experience. And then I'll get into exactly how I trade. Okay? Because no matter what you trade, anything, you will have series of losses. And some of the world's best money managers that I speak about in my book that just came out, these are guys that are doing anywhere between 15% on average net of fees. They can have long periods. I'm talking a year, 2 years, they don't make money. So if these world-class money managers who've been trading for decades have series of losses, what makes you any different or me any different? Again, this lecture isn't going to say, well, you buy this indicator and you do this and you do that and all this. Really, the goal is to help you to succeed as a trader. And it doesn't matter if you're going to be a Forex trader, a stock trader, a day trader, or a commodity trader, because the idea, again, and I want to reiterate, you find a methodology that you can accept the losses, that you can accept what happens, and it matches your personality and your time frame. This is super important. Watch my mouse. Everyone focuses on entries and exits, or actually many don't even follow the exits. The key isn't on the entries and the exits. That's not what's going to make you a successful trader. Again, this trading is tough. It's a marathon. For 19 years, I've been doing it. Once I realized how unimportant entries and exits are, and I worked on the money management, I started succeeding. Personally, I believe in trend following. It's simple, it's robust, it fits my personality. Maybe it doesn't fit yours. And you know why I believe in it? Very simple. Richard Dawkins, who's the father of trend following, did it for 50 years. He was trading into his 90s. And he made money. Not every year. He always had losses. It wasn't magical. He had ugly periods also. But he didn't quit. And he traded for 50 years the same simple Dawkins breakout. The dentist, who was my mentor, Same thing. He started in 1979 with $200,000 with basically doing hand charts. There weren't computers back then. Simple trend following. He kept his losses small. He had the discipline, the patience to keep on going during the rough times and didn't quit. And the same analogy also with the turtles. They also, and then you know what? I'm gonna ad-lib that too, because you have Richard Dennis, who was one of the main turtles. He actually blew up twice, but it wasn't because of the methodology, because of the risk management that he took on, which we'll get into later. The key of successful trading. Simple, robust. I use a breakout strategy, like I just said. The idea with my colleague, my mentor, who's 80 years old now, he always had losses. He didn't try to prevent them. He always had long periods of elusive profits. I'll tell you this. Personally, in my trading account, not just my trading account, money management, it's really tough. For the last 2 years, and many other trend followers did not do well. I had a man who read my book, the book about compounding money, loved it, wanted to talk to me, loved the way I thought, and then he looked at my numbers and said, you know what, your numbers really aren't all that good. I like the way you think. I like the way I read your other book, the Bible of Trend Following. I like that. But the last 2 years you didn't do so good. But I told him, I said, what's your time frame? My time frame is for the rest of my life. So if I had two, let's say not abysmal, it just didn't do well. They didn't make a lot of money. I didn't lose a lot of money. 2 out of 19 years, is that so terrible? And in 2007 and 8, I did great. This is what it is, putting it into the time context. The other issue too is keeping your losses small, taking small percentage bets of your account size. What does that mean? I'll give you an example. In my 3 trading programs, I'm risking less than 1% of my account size on any one trade. Actually, in the 3 programs, I call it Formula 72L, where I'm risking less than half of a basis point, less than half of 1% on a trade. So it's a $300,000 account. I'm only looking to risk basically around $1,500 on a trade, and let's see if it works. And what I say to myself is, how much will this cost me to see if it'll work? I accept the losses. I don't just put on a trade and because I did my analysis, let's say, I believe it has to work. I believe anything can happen. You need to accept that also. And it's ACH. Anything can happen. And that's why you need to have stops also. You need to have a trading plan. That is the key paramount issue. Instead of worrying about entries and exits, what you need to focus on is what to buy or sell. How much to buy or sell. When to exit with a profit or loss. Every potential contingency is pre-thought out. There's no surprises. You're not going to be like a deer with the lights on and freeze in the middle of a trade because everything is planned. And you can even automate it, or, again, it's all there. When I'm saying what to buy or sell in MetaStock, which is just great for me, it's easy, all I do is I rank the markets. There's a simple indicator where I look at a group of markets, let's say the stocks. I want to buy the strongest stocks if I can risk less than that 1% of my account size. And I do that in MetaStock. Really easy. And then, you know what the point is? These are all rule-based. And I've had people tell me, traders saying, that's boring. Well, you know what? Boring is good. I don't like adventure. I'm looking to compound money for my wife and my 3 children and my golden retriever here and my other dog who's sitting right next to me. This is what the deal is. You have to have a plan. You have to believe in this plan. Have the patience to let the plan work out over time, and the discipline to stick to the rules. I get this because I'm managing money. How was last month? How'd you do last year? Well, guess what? It means nothing. And it should not mean anything to you either. You need to commit to this. You need to find a simple, robust idea. And again, I'm very biased because of trend following. Not that I'm a rocket scientist, because I'm not. The fact is, it works for other people. It worked for Richard Dawkins, but it wasn't easy. It worked for the turtles, but it wasn't easy. It worked for the dentist, but it wasn't easy. But the fact is, it does work over time as long as you follow a plan and manage the risks and have money management. What you need to also realize, I wrote here, you look over long periods of time, over a series of trades. I call it the next 1,000 trades. When I'm putting on a trade and I'm risking, let's say again, I'm risking 50 basis points or half of 1% of my account on a trade. Any one trade doesn't mean anything. I don't have any anxiety. I don't get excited. Nothing happens. I'm immune to it. And you have to think in a series of trades for years. For me, it's the rest of my life is when I want to keep on trading. Trading's a journey. And the fact is, you know what? No one's just born into this and it's great and it's easy. I made every mistake possible when I first started, even if I had these people helping me. I overrid it. I panicked. I got greedy. The fact is, once you had the plan, and then I had someone looking over my shoulder saying, well, why'd you do that? Or why'd you do that? Then it started dawning on me that was really, not the smartest thing. Once I stopped looking for magical indicators for the entries and the exits and focused on the trading plan, which those attributes, basically what to buy or sell, how much to buy or sell, when to exit with a profit and a loss, I started becoming profitable. I started becoming consistent. This is what it's all about, is to internalize that. Focus on the money management is so much more important and the risk management than these simple entries or exits. I'm going to give you an example of one of my accounts. And I show this to, actually I made a YouTube video on it, and I just really show you what it's about. How easy it wasn't. I guess it's one of my obsessions. I'll wake up in the middle of the night and think of ideas to test. I love building mechanical trading ideas and systems. And, the fact is, this is one that's been going on for about 8 years. It's a proprietary account. On a gross basis, not net of fees or anything, it did 19.75%. Sounds great on the surface of it. But you know what the reality is? I'm going to show you some realities of these charts. You can kind of see this equity curve here. But I blew up that equity curve to show you more. So at one point I had a 30% drawdown. That wasn't fun. But I didn't quit. Could you really trade this? 19.75 gross, that's really a good number. But you know what? For the first 7 months that I started trading it, nothing happened. And for the next 10 months, nothing happened again at times. This is the truth about trading. That about 70% of the time when you trade, that you can either be in a drawdown or a sideways activity. You see these, it's just absolutely ridiculous to me, these trading robots that 80% profitability, all these things. The idea is you have to work. You have to have a plan. There is no way to avoid losses or drawdowns. You have to accept them. But again, I'm being very repetitious. But the fact is, you need to keep the losses small. Successful trading can be learned. Let's face it. I was talking about the turtles, Richard Dennis and Bill Eckhart. Bill Eckhart's still trading. Richard Dennis, his partner, blew up twice. But the fact is, they taught the turtles, and actually I've invested with many of the turtles. The idea was they were given a 2-week course. And in that 2-week course, they were taught a breakout methodology, basically, pretty simple stuff. But more of it was spent on the psychology, the money management, and the risk management, as opposed to the entries and the exits again. And I said here that some of the turtles are still trading. For decades, they're still trading. You have Elizabeth Chevelle. You have Eckhart. You have Saxon, which is Howard Seidler. And then you have turtles that blew up because they risked too much per trade. You have, what do you call it? Again, Richard Dennis. I don't know if Curtis Faith is trading. I don't know. You don't hear about him. I don't know if he's managing money. The same thing with Russell Sands. I just know he was teaching. I don't know if he's trading. Eckhart. Let's put things into perspective. Compounded annual rate of return, 19.92%. Pretty awesome. But be real. Be balanced. He had a 40% drawdown here. This is a world-class money manager who basically, if you allocate it to him, I mean, right now it's kind of a little steep, $10 million is his minimum investment. But imagine that you compounded $100,000 at 19.92% since 1991. So you got 23 years, 22 years. That's a lot of money. But you know what? Look at this. Look how much he fell here. That's not fun. And you know what? People probably took money out of him. And all this flat period here, he didn't make money. Chesapeake. He's another trader, a turtle trader, Jerry Parker. Interesting. He just had his worst drawdown. Look at this, down 36%. But if you had stayed with him, imagine you invested, again, just $100,000 and stayed for this whole ride. Like I said, it's a lifetime strategy. Can you imagine how much money you would have? So you're almost talking from 1988, 98, 2008. That's a lot of years to compound money. And you know what the interesting thing is? In my book about the Bible of compounding money, I talk about investing with these type of managers that have at least a 10-year record, and you buy their drawdowns. And again, anything can happen. Anything is 50-50 because, like here, past performance is not necessarily indicative of future results. But the interesting thing is, here's a guy that outperformed, believe it or not, if you want to look at all the dates, so many other managers. He had $2.5 million under management. Now he has probably either 500 or 600 million. Because he had a bump in the road. Like I said earlier, no magic manager, no magic system, no magic anything. So don't think you're going to be any different. Why these guys succeeded, they traded their personality and they didn't give up. That's what I want you to do. I don't want you to give up. You build a trading plan and you follow it. And accept that there's going to be losses and you keep them small. They're surviving turtles. They planned. They had rules. The strategies worked in the past. But you know what? The interesting thing is, even if all these rules, and you have to accept them yourself with the trading plan, it doesn't mean that you're going to make money year in, year out. Like I just showed you 2 examples of what I'll call world-class money managers, while being fully aware that their trading results will not yield positive results. All these turtles who were so successful all had varying amounts of success. Not because of the system. They all learned the same thing. Because of their trading psychology and how much they were risking on a trade. The more the trader and the more you risk on a trade, the more you can make. And also the more you can lose. I'm not sure which oh, this is Chesapeake. Imagine investing with this gentleman. made 48%, 28%, 43%, 12%. My God, who wouldn't want to invest with him? But you know what? Here's a guy in the last 2 years went through the roughest patch ever. And when most of his investors left him, he had a pretty awesome month right here in January. And it's going to be the same with you. It's going to be a series of trades. You do the same thing over and over and over again. You do not jump system to system to system. You cannot do that. You find something that makes sense and accept the fact that nothing is perfect. Drawdowns are inevitable. I'm showing you that. Even world-class money managers are going to go through those problems. These world-class money managers, they don't jump ship at the first drawdown or flat period or, as I'll call it, elusive profit. They believe in it. I'll tell you about this with the dentist. He took $200,000. He always had losses. He tried his best to keep them small. Again, nothing is perfect. There were times he had limit moves that went against him. He had trades that gapped against him that were a little bit bigger losses than he was happy with. And he had many long periods. He didn't make money, but he didn't quit. And he took that $200,000 to $18 million. The other thing I want to point out, and at the end, my email is here, or I'll just tell you, it's just Andrew@trendfollowingmentor.com. There was another turtle. It's Tom Shanks from Hawksbill, and I'll give a disclosure. I have money with him. I want to have money with him as long as he's trading. 2 points I want to make. First of all, Tom Shanks is a volatile trader. At one point in his career, he had a 60% drawdown. To make it balanced, that's pretty tough. I don't think many people could stand that. I don't know if I could. I bought his drawdowns. But what's interesting is his first investor, and I'll email you this article. It was in hedge. And basically, this first investor put $300,000 in with Tom Shanks. He put it in $300,000 in with Bill Eckhart, and he put $300,000 in with Howard Seidler. Today, that's $90 million that this guy has compounded. And it wasn't easy. He went through drawdowns. He went through ugly periods. He went through flat periods. But this investor didn't quit. And you don't have to take my word for it. There's an article. I'll send you the article. It talks about just Hawksbill. It puts you in touch with these. You can even ask the money managers themselves. This is what it's about. It's a marathon. When we trade, there's only 4 possibilities. That's it. Big losses, small profits, large profits. The first and largest mistake that traders make is they let themselves fall into big losses. I want to see a show of hands. How many of you have had a big loss? Let's say more than 5% of your account size. Okay? Everybody's saying yes. Well, good. 25%, my God. Anyway, my goal, if you get nothing more out of this video or this webinar, do not risk more than 1% of your account size. I mean, you might be a cowboy, but you know what? There's always a drawdown out there that will stop you from trading. So avoid the big losses. Do not trade more than 1% of your account size. What does it mean? Just so we're clear. $50,000 account, don't risk more than $500 on a trade. $100,000, no more than $1,000. So what's going to happen is you negate these big losses. That's the goal. You negate them. The other reality, which hopefully I put in this slideshow, I don't remember, I did this about a week ago or so. You are going to have small losses. There's no way to avoid them. But guess what? It's okay. No one's perfect. And then you know what's going to happen is you're going to have a lot of small profits, which are going to offset them. That they're going to negate each other. And then I'll tell you what happens with me. You're going to stumble into some big profits. Not that you were smart or you knew something. Sorry to tell you. Or I'll give you a funny story with my wife and I. You stumble into big profits. Rare times, like out of 100 trades. Play the probabilities. You avoid the big losses. Most of your other trades are small losses, small profits. They negate each other. And then maybe out of 100 trades in a year, you might have 4 or 5 or 3 or 6 that are some nice sized, winners. I was at a party a couple years back with my wife, and just for whatever reason, I bought a breakout on the Canadian dollar, and remember the Canadian dollar really took a nice big move. Well, the fact is, my wife said, "Oh, my husband bought a lot of Canadian dollars," and the people asked me why, and I said, I don't know why, because it broke out. Why did you buy them? You don't have to know the whys. Take the whys out of the equation. Just use a simple breakout if you want. That's what I use. I said this earlier, but here it is, because this is what I believe, and I have a little stickum next to my computer, because it's easy to get frustrated. And I'll tell you this also, a thing I do, I don't really need to watch the screen during the day. It doesn't do anything for me. And I'll tell you a funny story in a second. Any one trade doesn't mean anything as long as you keep your losses small and your risk on a trade small. Think in a series of trades. I'm saying the next 1,000 trades, maybe let's say it's 10 years, a couple thousand trades. I got maybe 4,000 trades left in me. And don't get bent out of shape when the trade doesn't work. Big deal. Next. If these big money managers that, again, like Eckhart, his minimum is $10 million, and he has trade after trade after trade that doesn't work, or series of losses, and he doesn't get bent out of shape or quit, that's what you need to learn. My little funny story. I was talking to, actually, it was a family office, and I was showing them, we were discussing one of my programs, and he just went, "Oh man, wow." I go, "What happened?" He goes, "Oh, it just went down." And he goes, "Well, maybe it'll go up, go up, go up, go up." Like he was talking to the screen. How many of you guys talk to the screen trying to will a stock or a position to go up or go down? I'm sure you do. Put your hands up. Let's see. Come on. Has anyone done that? Talk to the screen. Okay. Chip has. Dennis. Ross hasn't. Okay. Good thing. Talking to the screen doesn't help. You don't even, if you're in trading dailies, you don't have to watch the screen. Have your plan. Avoid the aggravation. Have everything thought out. Put your stops in. Put in a buy stop. If you're filled, like when I get filled, I get an email. So then I put in my stop. That's it. Nothing more to think about. These are my trades. Series of trades. Loss, 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 loss. Wow, here's a big profit. 0.08%, a whole whopping $100. Loss. Oh, another big profit, $92. Loss, loss, loss. How many of you would quit this system? Let's see a raise of hands. Get me out of here. Okay, well, guess what? This is the reality. But I'm going to show you what's pretty cool. Keep on going. I'm having all these little losses. Uh-oh. I stumbled into a huge trade. Huge. 12%. Here's a 2%er. Here's a 3%er. They make up for a lot of these small losses. If you notice, there's not a big loss here. That's the key. Keep the losses small. There are no gurus. Like I've been saying, temper your expectations. I gave you examples of some, and I'll call them unique money managers. They're rare because you know what the fact is? Like 90% of traders don't succeed. I'll tell you that most money managers also don't succeed. There's only a select handful that I would ever invest with, and I have exact rules in how I invest with them. I want to buy their drawdowns. I mean, that's like, people think that's crazy. You know, they do the opposite. They buy when a manager is doing good, and they sell them when they're doing bad. I want to find a guy that's been around for a long period of time and goes through a inevitable period that's rough, and then to buy his drawdown. So even these best money managers, they're making 15 to 20% after fees. Take out of your head that you're going to make 50% per year, because I'm going to tell you something. It's not realistic. I've yet to see it long-term, consistent. Because you know what the fact is? We're talking about compounding money. How many of you know about compounding money? Let's just see a show of hands. Raise your hands. Okay, great, Chip. Yes, that is the key. Our goal is to compound money. The rule of 72. If you can get 15%, which is tough and rare, so every 4.5 years, let's say, you're doubling your money. That's really what this is all about. That's what I've been trying to do since 1994, and it's been a battle. It's not easy. Don't quit. Here, one of the attendees said he wants to make 30% a month. Okay, that's nice. The idea also is, do not quit on your first drawdown. Don't seek the newest and greatest new system or money manager. People always do that. The example, John Paulson. I mean, first of all, he was amazing. He made a great big bet with the housing market. He made a fortune. And then he's been making all these other big bets that haven't been working, like his gold bet right now. So the fact is, you know what? And there's so many people that allocated to him after his great run, and that's what I talk about in that book about compounding money. That's not the way to do it. Buy a manager who's on sale, who's been around a while, who gets it, who, you know what, is consistent. What it takes to succeed. A robust trading methodology that matches your personality, and you accept the realities of trading it. Again, simple works. You don't have to go to Wharton. You don't have to go to Harvard. Again, I mean, if hopefully Dave or Derek will invite me for another one of these webinars. I'll go through and give you exactly my trading plan. And people say, that's it? Well, guess what? That is it. I mean, I know what I'm looking to buy. I know how much to buy. And I know when to get out with a profit or a loss. It's not rocket science. It doesn't have to be. So that's your first thing that you can do. Or you can go into I'm not talking about me, but you find a guy that's been around at least 10 years who understands risk, and you can invest with them. But then the thing you need to realize is that even if a guy, and again, the reality is like this: anything can happen. I said it. ACH. That's another one of my little stickers that I have on my computer. Because past performance is never indicative of future performance. You might have a great money manager who has a drawdown, and then you know what? That drawdown can get worse. It definitely can happen. There's nothing perfect. So what I also say is I don't invest more than 1 to 5% in any one idea. Spread it out. What it takes to fail. The biggest mistakes revolving about not having a trading plan. Over leveraging. That means risking too much money on a trade. There's more than just that, because what it boils down to me is I look at risk per trade, risk per sector, and open trade equity risk at all times. And then I have other money management and risk management ideas where I have a maximum dollar amount per contract when I'm trading my futures and commodities. And the other idea is lack of patience and discipline. Like I had one student that I was doing a one-on-one mentoring, and he was in a great trade, and he exited it. And I asked him, I said, what happened? Just like the same questions that were asked to me when I was starting. And he said, well, he got bored. He wanted to find something else. Excuse me. Well, guess what? That's a lack of patience. That doesn't work. I guess this goes to the good part. I guess I'm not sure if you're MetaStock users or you're not users. I put this in the webinar that Dave and Derek, that they're basically they've offered me to be one of their resellers. So I mean, there's a discount, and you have all kinds of 3-month subscription, all kinds of goodies here. And also here, Kelly's asking if you can, available to print or save. I can email you the PowerPoint. Here, let me give you, and here's my email. Oops, 1 second. Oops, I don't know. Okay. Also, if you want that article with Marhedge about Hawksbill, that's a wake-up call. It was a wake-up call for me. It was written in 2003. I'll gladly email it to you, send it to you. Again, this is how I can be contacted. You can email me. These are just 2 of my books. I have a bunch more on Kindle. Or actually, I just started making like little paperbacks also. If there's anything I can help you with or assist you, you can email me. I'll try my best to give you the best of my ability, the directions. I think that's it. That's the last part of it. I'm open for questions, and then I'll bring it back to Dave. Okay, I have one question coming up. Do you think my crystal ball? This is the question that Heinemann asked. Do you think the market will be up tomorrow? Well, my crystal ball, I always say this, my crystal ball, I forgot to plug it in. And you know what? It doesn't matter if it's up, down, sideways, or whatever. I have a trading plan that I'm following that I really don't get emotional any which way. I put on trades, I take off trades. I'm not putting a big risk on any trade, so it doesn't mean anything, any one trade. And hopefully you have gleaned that, and that helps. Here, do you think lot size makes any difference? 1% doesn't allow many shares. Well, I'm going to tell you something, Bruce. Imagine you put, let's say like this. Let's use an example again. One of the best things I love MetaStock with is that I rank markets with MetaStock. You can do like what I do with my stocks is I look at the IBD 50, I make up a group, and then I rank the IBD 50, and I want to buy the strongest breakouts of the IBD 50. Pretty simple stuff. Imagine you bought Netflix or Melanex, and it was 1% of your account. Don't expect to get rich on any one trade, but imagine using the idea of Netflix. That stock broke out in the 60s, went up to like a crazy amount, and also imploded. 1% is more than enough. It's like a little tugboat. That little tugboat can push a tanker all around. 1% is even more than enough because the pendulum swings both ways. You can have a bigger loss than you also anticipate. Best advice for me as a position trader is not to watch the markets during the day. Exactly. You don't have to. There's no point. You have buy stops. If you're like me, you get an email. I'm filled? Okay, I'm filled. Great. I put in my sell stop. How hard is that? 2 seconds? 3 minutes? Okay, let's see. What's the rule for setting up the stop losses? I have 2 stop losses. Again, I'm a trend follower. I'll buy the X day high, I'll sell the Y day low. That's my hard stop. Then, if the trade works, again, because it doesn't have to work, I trail it with, I have a couple of like indicators, very simple. They're like an average true range type of trailing indicator. There was an article that I wrote in Stocks and Commodities magazine back in 1999 or 1998 called the Trend Rider line, which is a variation of an average true range with a little bit of a volatility twist. if it again, part of your rules, because there's, these are my rules. If it touches the trailing stop, I'm out in one of my programs. In another one of my programs, it has to close. If it closes below it, I'm out. So again, there's nothing perfect here. What's the maximum capital committed in a trade? I don't think of capital, and I don't think you should either. Think of percentages. Everything is percentages. Again, what I'm risking in my 3 accounts that I'm trading, well, actually it's 4 because the stocks, I'm not managing money for anyone through my stocks. I'm risking half a basis point on my stocks. On my Formula 72L, I'm risking about 40 basis points. Formula 72M, which is mid volatility, is 65 basis points. And you ready for this? Whoever asked me about the 1% here, Bruce asked me about is not enough. I'm risking 75 basis points, 3/4 of 1%. And I'm going to tell you something. When you're trading commodities, you're going to have some swings. There is some volatility there. Okay? Are there any other questions? I don't understand this question. The problem is the trails don't work with high volatility. Well, guess what? Heinemann, you're looking to basically prevent a loss. The trailing stops work on everything. They work on Forex. They work on high beta stocks, triple beta stocks. They work in commodities. But the fact is you have to accept the fact that when they touch your trailing stop, that, you know what, then the trade is over. And that's what you have to say. The trade does not have to work because you think it has to work. Okay, any other questions? And then I guess, Dave, you can take over. Oh, here, some other people are typing. Okay, good stuff. Oh, here. Does it mean you can spend more capital in one trade as long as you tighten the stop loss? First of all, I'm not doing any... It's not my opinions. My opinion doesn't mean anything. And that's also another very important issue. And I'm really important that you brought this up, Dennis. That on any trade, I'm consistent. I don't say, well, I like XYZ stock, so I'm going to risk more. I don't like this stock, so I'm going to risk less. Because you know what? I do not know the future. Okay? No one knows the future. I put on the same size bet on every trade. And write this down. I think this is awesome. And I have this next to all these little stickums all over the place. Besides the, think of the 1,000 trades and all that kind of stuff, is how much is this trade going to cost me to see if it's going to work? Take out of the lexicon that the trade has to work. It doesn't. Here, Bruce, the Turtles pyramid of trades, adding to positions. Do I agree? Well, look at it this way. Richard Dennis did it, and look where he's at. He made a lot of money. He lost a lot of money. I personally do not pyramid. I know people that do. I have 2 money managers that I have money with that do. One is going through the worst drawdown they've ever gone through ever. They're down 40%. I have another money manager who's pyramiding who actually did pretty good. I think last year, I'm not exactly sure what he did, because every time that he would have like a great run, I would say, you know what? Close all the positions and let's start again. So I think I made maybe 25%, but he, or more with him. But he does pyramid. Any other questions? Well, I thank you, Kelly. And hopefully I've given you some, again, my goal was to give you an aha experience as opposed to just another, okay, I trade this and do this and do this. We can do another lecture like that if I get invited, and I'll tell you exactly how I do it. Gladly. Nothing, whatever. Thank you too, Bill.
Well, and Andy, we would love to have you back to do just that, my friend. Fantastic presentation today. We will get you on the schedule, and I'm sure everybody here today will love to see that in their email box, that you'll be back. Really appreciate that. For those of you who are in the room who don't have MetaStock right now, take us up on that. Certainly want to make sure you get a copy so that you can do some rankings and setups of your own. It works for you. There's those contacts and those addresses. If you'd like a recording of this webinar, you can go ahead and also just check our YouTube channel, youtube.com/MetaStock. Should be posted there in the next couple days. Thanks, everybody. Thanks, Andy. Everybody.